All right, ladies and gentlemen, let's go ahead and get started with today's 1031 exchange webinar. This is going to be a really quick webinar. We're just going to talk about the basics of the 1031. So if you've got 10 minutes, that's all we're going to need for today. So before we get into the nitty-gritty, I want to introduce myself. My name is Leonard Spoto, and I am one of the principals at Asset Exchange Company. I've been in the industry for almost 20 years. Started this company back in 2006 with my business partner, Adam Skarsgård. We've been through the good, the bad, and the ugly in the 1031 exchange business. So we have seen some rough patches. We've seen the good part, and so we are a veteran of the 1031 exchange business, and we are here to help you benefit from our experience and knowledge. Now, Asset Exchange Company is a qualified intermediary. If you plan on doing a 1031 exchange to defer taxes, you need to use an exchange accommodator or an intermediary. You cannot do an exchange without an intermediary. Now, here in California, we have some guidelines in terms of insurance and bonding. Our company is compliant with the California state law. We do carry errors and omission insurance as well as a fidelity bond to protect client funds. My business partner, Adam Skarsgård, is also a licensed attorney with both the California Board of Accountancy, he's a tax attorney, and the California State Bar. Now, my company is unique in the industry. We are the only company in the industry that offers clients free audit support. If you have your 1031 exchange challenged by the IRS, you can call us up and we will help make a defense so that you can show the auditor that you are in compliance with the tax law. No other company in the industry offers that. Now, hopefully you don't ever need it, but if you do, it's nice to know that you don't have to go out and hire a very pricey attorney. We will have your back, we will help you make the defense, and hopefully the IRS will go away. Now, everybody should know that the reason why you do a 1031 exchange is simply to defer taxes, but many people do not know what the actual tax rates are. Some people think the tax liability is a mere 15%. That is not the case. If you do pay taxes, you are going to pay taxes at both the federal and state level. A rundown of the federal taxes here in 2017 are as follows. Number one, you have a federal capital gains tax. That is 15 unless you make over 400 or 450,000 as a married couple. Then your capital gains tax bumps up to 20%. On all investment property sales, there is a depreciation recapture tax of 25%, and that means you have to pay 25% of the amount of depreciation you've taken over the life of that property. And then finally, there is a 3.8% Medicare tax. This tax came into effect back in 2013, and that is 3.8%. So that's a rundown of the federal taxes. Unfortunately, it does not stop there. If you are in the state of California, like I am, you are going to pay state taxes as well. Now, obviously, every state has their own tax structure. Some states don't even have taxes. But here in California, we are looking at anywhere from 9.3% to 12.3%, and that rate depends, of course, on your income. Now, some of you might be thinking, well, what is the bottom line? Well, if you are a California resident or you're selling property in California, the bottom line is that you're going to face a blended rate of about 33%. So if you made $100,000 of profit on the property, expect about 33% of that to go to pay the various taxes we just described. Now, of course, the good thing about the 1031 exchange is that with the 1031 exchange, provided you do it properly, you are allowed to defer that capital gains tax liability. Now, let's talk about how to stay in compliance with the tax law when you're conducting your exchange. I've broken down the guidelines for successful 1031 exchange into 4 basic requirements. Number 1, when you do an exchange, you need to make sure that your properties qualify. How does a property qualify for 1031 exchange? Well, it must be held for productive use in trade or business or for investment. It also must be like kind. The properties involved in your exchange must be like kind. Now, what does that mean? Well, some clients make the automatic assumption that if they sell a 2-unit building and they would like to do an exchange, they have to buy another 2-unit building, and that's not the case. All right, the like kind requirements are a little bit more broad and favorable. You actually can buy any other type of investment or business use property. So if I sold an office building, I can exchange into land. If I sell land, I can exchange into a rental home. If I sold a rental home, I can go back into another office building or a multifamily property. Anything I want. The asset class or the type of property doesn't matter. What matters is the use. Are you using the property for business or investment purposes? If so, that property will qualify. Now, the other thing to note here is that you can trade property anywhere in the country. So if you sell in California, you can buy in Texas. If you sell in Texas, you can buy in Florida, anywhere in the country. However, if you were selling in California and you had designs to go and exchange into a property in Cabo San Lucas, Mexico, that is not allowed. Foreign property is not like kind with domestic. If you sell in California in the United States, you need to buy in the United States. Again, anywhere in the country is fine, just can't leave the United States. Now, one other thing to note, inventory is not exchangeable. Inventory is something that you buy with a specific intent to sell. So for real estate purposes, we look at quick flips and also development deals as being inventory. So the bad news for you flippers out there is that your quick flips are taxable transactions and do not qualify for 1031 exchange. Now, the same is true for development deals. If you develop a property and as soon as you're done, you put a sign on the property for sale, well, that sale will be a taxable event. If you don't want your quick flips and development deals to be taxed and you would like to exchange them, you need to season them as an investment. And we generally advise clients to season your investment producing rental income for at least 2 years, preferably more. 2 years is a good amount of time for that property to have been reported on your taxes, producing rental income, depreciating, so that if you get audited, you have a very good defense that the property, in fact, was eligible for 1031. All right, so rule number 1, make sure those properties qualify. Now, if you have any questions on your specific property, whether or not it qualifies, pick up the phone, give me a call, shoot me an email. We're happy to help out and do consultations. We talk with clients about these issues every single day, all day. All right, so rule number 1, does your property qualify? Assuming your property qualifies, when you do your 1031 exchange and you don't want to pay taxes, you're going to need to remember 2 things. Number 1, reinvest all of your cash, and number 2, purchase property equal or greater in value. Now, this is simple, but people get confused all the time. What we look at is your net sales price. So if you sold a property for $1.1 million and you paid $100,000 in closing costs, your net sales price is going to be $1 million. That is the value that you need to replace. So our building over here sells for $1 million. When we do our exchange, we want to be targeting acquisition properties worth $1 million or more, right? We want to purchase property equal or greater in value. Now, the other thing that is very important is that you spend all of your cash. All of the sale proceeds will need to be used as a down payment on the replacement property. Provided you do that, you spend all of your cash, and you purchase property equal or greater in value, you will defer all of your tax. Now, you can see some problems coming up where if you don't buy enough real estate, right, if you trade down in value, or if you pull some cash out, then you'll have some tax issues. Not the end of the world. You can always do a partial exchange, and you can always take some cash or trade down in value if you want. For example, if you sell for $1 million and you decide to buy for $950, the entire exchange isn't disqualified. You just pay taxes on the difference. All right, so partial exchanges are allowed. The other thing to keep in mind is multi-property exchanges are also an option. You could sell one property, buy two. You could sell 4 properties, buy 1. But whenever you do that, if you don't want to pay taxes, just remember these 2 rules. Number 1, reinvest all your cash. And number 2, purchase property equal or greater in value. All right, guideline number 3. When you do your 1031 exchange, you have a timeline that you need to abide by. The tax law gives you exactly 180 days to complete your exchange. That time frame starts day 0 at the close of escrow. You have 180 calendar days from the close of escrow to complete the acquisition of your replacement property or properties. All right, so plenty of time, 6 months to go out and find, locate, and close on your replacement property. Now, the challenging part of our time frame usually isn't the 180 days. What most people find a bit constraining is what they have to do on day 45. Now, the tax code requires that on day 45, you submit an identification letter stating the properties you're considering acquiring to complete your exchange. So within the first month and a half, the first 45 days, you need to know what you're thinking about buying. And you have a total of 180 days to buy it. But on day 45, that's very important. Day 45, you need to submit in writing the properties you're thinking about acquiring. Now, how do you do that? Well, the government gives us rules on how to fill out our identification letter. 2 ways that are common, the 2 most common ways to do that are, number 1, with the 3 property rule. The 3 property rule will allow you to submit 1, 2, or 3 pieces of real estate. Now again, this is due, these properties are due on day 45 in writing, and once you submit those properties, you cannot replace them after day 45. Very important. You cannot modify your identification letter after day 45. So if you commit to these 3 properties, you need to purchase 1, 2, or all 3 of just those 3 properties. Now, as you can imagine, the challenging part of the 1031 exchange is if property number 1 gets sold to someone else on day 46. Well, that property can't be replaced. You now have 2 options left. If property number 2 burns to the ground on day 47, it cannot be replaced. You've got that 3rd and final property. If you cannot get into contract and close on it, you do not have a successful exchange, and you can expect to pay your tax liability. All right, so day 45 is very, very important. Now remember this, ladies and gentlemen, you can go out and write offers on 200 different properties in the first 45 days, but on day 45, if you're not in contract on something, you're going to go ahead and have to submit your top 3 choices. Now that's if you use the 3 property rule, all right? There is another rule, another option, and that option is the 200% rule. With the 200% rule, you are not limited to 3 properties. In fact, you can identify as many properties as you want. So in my example here, I've got 5 pieces of real estate that I'm going to submit on my identification list. So no limit on the number. The problem with the 200% rule is that when you nominate with this rule, you are constrained to a total value of 200% of what you sold. So let me give you an example, ladies and gentlemen. If the property you sold was a $1 million property, over here when you identify, you can nominate $2 million worth of replacement property. So again, in my example, that's 5 properties. The total value does not exceed 200% of what I sold. Now, in all reality, most of my clients will sell one, buy one, and they will use the 3-property rule. But every once in a while, I have a client who sells a very large asset and goes out and acquires several small pieces of real estate. All right, so let's recap real quick, ladies and gentlemen. To effectively do a 1031 exchange, you need to make sure that your properties qualify. You need to reinvest all of your cash and purchase property equal or greater in value. You have 180 days to complete the exchange, and on day 45, you need to identify what you're thinking about buying. Now, we're going to wrap up real quick. Again, my name is Leonard Spoto, and I am one of the owners of Asset Exchange Company. If you have more detailed questions or would like more detail on the types of exchanges you can do, or if you have individual questions, please don't hesitate to reach out to me. You've got my contact information here. I can be reached via email as well, or you can visit our website. Thank you very much, ladies and gentlemen. It was a pleasure hosting this seminar today, and I look forward to doing business with each and every one of you in the near future. Take care.